Morning, ladies and gents. It is Simon Brown here doing our Wednesday session. We've been running through AutoShare Invest with an internet banking, the tax-free accounts, what are ETFs. We've done some basic sort of fundamentals and valuations of stocks and the like. And I've been promising that I'd come through and look at the structuring your portfolio and how to put together a portfolio. And that is what we'll run today. You got questions, drop them in the Q&A box. We've certainly got time for questions. In essence, I'm not delving into the sort of, which stocks. I'm looking at the broad idea of how to put together a portfolio. And what are we looking at here? We're looking, how you put your portfolio together is really around reducing risk. And part of that is, single stock risk. You don't want to only have everything invested into one share. That's great if the share is booming. It's a horror show if the share is collapsing. So, your first port of call is to reduce that single stock risk. But even with that, maybe you say, well, okay, I'll have two stocks. Well, okay, you've halved the single stock risk, but you've still got massive concentration risk. Even if you just had, 10 stocks, you've still got massive risk into just 10 individual shares in a world of which there are, 100,000 shares. In South Africa, a couple of hundred, but 10,000 plus in the US and globally easily 100,000 shares. You also want to reduce that currency risk. And on the JSE, you can buy businesses that operate pretty much exclusively in rands. You can buy businesses that have got a bit of a split between sort of rands and other currencies, whether those other currencies be into the rest of the continent, Europe, maybe Asia, like for example, Naspers and their Tencent, or of course into the US. So you want to reduce that individual currency risk. You want to reduce individual geographic risk. You don't want all your investments in one geography. Also sector risk. You don't want to just have, I've got 10 stocks, but they're all mining stocks. Well, okay, but if they're all mining stocks and you're taking massive sector risk in that they're all mining, and yes, there might be different commodities. Some might be gold, some might be the PGMs, platinum group metals, coal, etc. But you're in that mining risk. And then, importantly, in that space, if you were all into mining, you'd have currency risk because all of these commodities are ultimately sold in US dollars, and that then adds an extra level of risk there. And also, in a sense, asset class risk. Again, we've been talking equities over these different sessions, and but there's also the listed property space. There's also your cash and near cash, such as bonds, government debt, and the like. And then, and I'll touch on it a bit, there's sort of your alternatives as well. And where would they fit into that? Alternatives would be, for example, cryptos. It might be impact investing, something like that. Where does that fit into that part of the equation as well? So let's delve into it. And this is how essentially you structure it. It's kind of like a pyramid structure. Down at the bottom, you've got your exchange traded funds. You might also be wanting to put your unit trusts into there, and also your pension and provident. So if you've got a retirement annuity, or maybe you've got a pension scheme at work, that would fit down into that bottom sort of, I suppose instead of exchange traded fund, I should have called that CIS, collective investment scheme / retirement. And the reason why I would put the retirement products in there is because they are a basket. If you've got a retirement with whoever, Liberty, Allan Gray, Coronation, 10X, whoever it might be, if you've got a retirement annuity or a pension fund, that's not a single stock. That bottom part down there, which is you'll see is the largest part, is going to be a multitude of stocks and potentially asset classes. If you've got a Regulation 28 product, you'll have some blend of offshore and local, you'll have some property, you'll have some alternative investments, and further to that, you'll also have some cash or near cash, bonds and the like sitting down there. So that remains your single biggest space, simply because it comes in already diversified. It meets all of those requirements. It's not a single stock. It'll be across currencies, it'll be across geographies, it'll be across sectors, and it'll be across your different asset classes at the same time. So that nice and simply sort of solves your problem and says, we go into that space there, down at the bottom, and that's already automatically diversified and a structured portfolio. On top of that, you would put your sort of what in the olden days were called blue chip stocks. I mean, your large, high quality stocks would fit in there. Food retailers, banks, that sort of thing. Those companies that have been around forever and a day, and in most cases will continue to be around forever and a day. On top of that, you would put your small and mid cap. They're still listed, but they're smaller. In the case of South Africa, those are often more SA Inc. orientated, simply by a process of they're smaller companies. They haven't sort of globalized to the degree that your larger sort of blue cap stocks have. They're also smaller, so they can do much better return, but they also come with risk. It's harder when times are tough, often being a small company. Now, in some cases, truthfully, being a small company might actually be an advantage to you in that case. But certainly, they come with that higher risk, higher reward. And then at the top of the pyramid is sort of your speculative, your alternative assets. Now, that might be CFD trading, it might be index trading, FX, it might be something simple like who's it? Fed Group, who've got their bees and honeys and solar panels for investing. You can buy cows. It would be your crypto would sit up there. So your sort of your alternative assets, your impact investing, or perhaps your derivative trading, and maybe not even derivative trading, maybe just short-term trading. Again, your rewards are potentially better, but your risks are higher. Two questions coming in. The first is, where would you put currency? And that's a great question. So maybe you physically holding some US dollars or something. And I would say, well, it depends on the currency. If it's a speculative currency, one of the non-majors, then maybe it belongs in speculative. If it's one of the major currencies, and let's park ZAR for now. Your majors being dollar, yen, euro, and sterling. Some people put the Swiss franc in there. I personally don't. Those probably go down into your blue chip shares. And if you've got your more speculative currencies, perhaps they're the small or mid cap. And if you see sort of how I've placed it there, it's very much a case of it's that risk reward component. If you've got a second tier currency, higher reward but higher risk, whereas a top tier currency, lower reward, lower risk. So I would put the top tiers in blue chip, and I'll put the sort of second tier currencies into small and mid cap. And the other question was, are these all exchange traded? And not necessarily. It depends on the exchange, but some of these might be OTC products, over the counter, such as if you're trading CFDs. Impact investing in many cases would not be exchange traded. For me personally, I only invest into exchange traded product, and I'm the CFDs, which are OTC. As long as my counterparty is a large organization, the Standard Banks of the world, I don't stress that. But I don't invest into unlisted companies, which would also, I imagine, go into speculative. I don't do anything sort of off market at all. So that's sort of the structure to be looking at and how to position it. And then comes the question, well, okay, but how much? How much in each? And your bottom line, which is your ETS, which is that base down at the bottom down there, I would say minimum 50%. And up to 100%. I say this is safest, and I asterisk it. It depends what's in there. Equities in the short term can collapse. Anything in the short term can collapse. So it really is going to be a case of in the short term, there will be market risks. We saw that happen back in March of this year as markets collapsed. But over the long term, they recover and they generate reward and ultimately return. What we've also got in that space would be your ETFs, your collective investment schemes. It's, I think, important to look through and see your retirement annuities and the like as well. I think they do matter. How much, to my mind, is somewhere between 50 and 100%. And what I mean by that is that at a minimum, 50% goes into that bottom space. But there's nothing wrong with actually saying, you know what, I actually want to put 100% into there. And that just means you're taking a much more hands-off sort of passive approach. And that's perfectly fine. For the majority of people out there who would be investing, hands-off is exactly it. You've handed the money to an active manager, a unit trust, or a Regulation 28 retirement fund of sorts. Perhaps you just put it into an exchange-traded fund. And for most people, I say most, plus 90% of South Africans, it really is a case of that's where you invest your money. You do it on regular basis. You run debit orders on a monthly basis, and you put it into that nice and simple. So to put everything into 100% is absolutely a-okay. If you want to be some a little more active, you pull that number down. Now, at 50%, you're running a moderately risky portfolio, and that's because one of the biggest risks to managing money and picking stocks and the like is me or you. It's the individual. We pick bad stocks. We don't exit because we're emotionally involved or whatever the case may be. So putting it a minimum of half into a nice broad-based significantly does reduce and manage that risk. And then you just push it up. And perhaps the way to start is to start with 100%. And as that gets to a comfortable position, then some of the money that would normally flow into that base mode can start flowing into blue chips. And when you're comfortable with that, start flowing into smaller mid cap. What I never suggest is don't start at the speculative point. Don't wake up in the morning with no savings, no retirement, no ETFs, no nothing, and say, I'll be a trader. You need that base underneath to support, because trading comes with great reward but great risk. For me personally, in my ETF space and ETFs, it's sitting in the high 50%. It was bang on 50%. I've been pushing that number up over the last couple of years, and my sort of medium-term target over the next 5 or so years is to probably get that to around sort of 65, maybe 68 or 70% as I push that higher. Your blue chips, then somewhere between 0 and 30%. And these are, in the South African context, your top 40 stocks to a large degree, your large quality companies that have been around for forever and a day. We call them boring, but go have a look at the ShopRite price. The share was 100 Rand back in March at the lows of the collapse, and after really good results, it was 150. Now, it's not going to do that every 6-month period, but there's certainly a space there. And those are the sort of companies, they're paying good dividends. They're probably going to be around long after we're not. And those somewhere between the 0 to 30. Then small to mid caps, which is your 0 to 15%. As I said, those risky, but they can be rewarding. And what's important here is, again, you might decide to do sort of your ETFs, Reg 28 and blue chip, and not have any small to mid cap. That's why all of these three have as a base level a 0 number. Certainly 0 as a start point. You can push that number higher, but careful of how much higher. And then your speculative right down at the bottom is very much your sort of, I would say, 0%. Again, in most cases, people should stay away from the speculative space, but up to perhaps 5%. And a little bit at the top. Now, when you're starting out and you say, but hang on, Simon, I've only got 10,000 Rand, 5%, that's not going to help me at all. That's what's that, $500? I can't trade with $500. You're correct, and it's what I said is start with the base of the pyramid. Build that part down at the bottom first and get that really sort of operating at a good size. Build that part and then slowly work your way up. And yes, it's going to take some time before you've got that capital for that speculative at the top. But that's, investing, even trading is a game around time. It is around spending the time and having that time. And that process is going to be, it's going to be measured in years. It's not going to be measured in days and weeks. And then those numbers will change, depending on I'm reducing my ETF, and I took that money which I've reduced from out of all the other three components, out of some of my blue chip, out of some of my small cap, and some of my speculative. Now, I didn't sell off. Well, in the speculative, I took some of the cash out. I'd been trading various systems, and I've now narrowed it down to just one I'm trading. So by closing down some of those trading systems, then some cash freed up, and instead of putting it into my other trading, I just moved it into my ETFs. My blue chips, I haven't been massively selling them. What I've done is, as dividends come and as new cash comes into the portfolio, I've just moved that new cash into my sort of ETF space. And then my smaller mid cap has been, I exited a couple over the last few years, and that portfolio has been, so that space has been sitting in a lot of cash. So I deployed that cash then into the ETFs. But as our circumstances change, as we get married and maybe have children, as we move up the corporate ladder and see our salaries start to increase, as we move closer to retirement and ultimately into retirement, we're going to see sort of different risk levels, and we will balance it accordingly. accordingly. And that balancing, doesn't need to be wholesale sales. It can, as I said, just, managing dividends, managing new money in. Question coming through, where would you put the tax-free component? The tax-free would absolutely sit down at the bottom side, because that is going to be your unit trusts or your exchange-traded funds. So they would sit down in the lowest sort of risk point. And that's a great thought. We're probably, if you're employed, you probably already got some sort of pension or provident in many cases, and therefore you've already got some of that bottom part. If you've been funding a tax-free account, you've added to that already. So you might think to yourself, I don't, but quite possibly if you've been working for a couple of years and hence investing into the markets, into a pension or a retirement annuity or the like, you'd be buying some tax-free and the like, you've probably already got a bit of a base down at the bottom down there, and in essence you can then start sort of growing up those channels and adding to it. But I stress the point I made, which is that this is very much something which is going to be measured in years as we build it. And ultimately, investing is something, and managing the process is something that we do for the rest of our life. It changes how we do it. What we're trying to achieve changes. Initially we're trying to build that capital. Then we get to the point where we're trying to protect the capital. And then ultimately we get to the point in retirement where we start to live off that capital. So it's those different stages that we go through that really sort of work the process and make it happen. We'll park that there. We've certainly hit our time. These videos are all going to be on the YouTube channel. Just go search Standard Online Share Trading. Mondays is our market standard. Myself and Dineo look at the week gone and the week ahead. Fridays we're looking at FunTech, and there won't be anything this Friday 25 or the Monday 28 long weekend. Dineo and I are taking some time off, and then Wednesdays we've been going through this series, and we'll kick off a new series starting in October. Ladies and gents, everyone have a great day further. Have a good long weekend. I hope you've managed to wangle yourself a Friday off to have some relaxing 4-day weekend. We'll chat again next week. Till then, my name is Simon Brown. Cheers all.